Debt and its implications is critical for evaluating a company's financial health and the risks associated with investing in its stock. Here are the key aspects to consider. Key aspects of debt analysis. Types of debt: short-term debt, loans or obligations due within 1 year, often used to fund working capital. Long-term debt, loans or bonds with repayment periods longer than 1 year, typically used for capital expenditures or expansion. Debt metrics. Debt to equity ratio, DE, measures a company's leverage by comparing total debt to shareholder equity. Higher ratios indicate higher financial risk, but may also signify growth opportunities. Debt to EBITDA ratio compares debt to earnings before interest, taxes, depreciation, and amortization, EBITDA, a common measure of a company's ability to service its debt. Interest coverage ratio indicates how easily a company can pay interest on its outstanding debt using its operating income. A ratio below 1.5 is often a red flag. Free cash flow to debt ratio measures how much free cash flow is available to pay off debt. Higher ratios indicate better debt management. Let's take a closer look at the cost of debt. We need to analyze the interest rates on loans and bonds. You see, high interest debt can really erode profitability and reduce the cash flow that's available for growth or dividends. Now, let's talk about the implications of debt for stockholders. There are both positive and negative impacts to consider. First, the positive impacts. Debt can be a tool for growth leveraging. It can finance expansion, acquisitions, or research and development, potentially boosting revenue and earnings growth. Plus, there are tax advantages. Interest payments on debt are tax deductible, which reduces the company's effective tax rate. But there are also negative impacts. Excessive debt increases the risk of default, especially during economic downturns. High debt levels can also reduce the company's flexibility, limiting its ability to invest in growth opportunities or weather financial challenges. And there's the risk of shareholder dilution. Companies with unsustainable debt may issue new equity to pay it down, diluting existing shareholders. Debt's influence on valuation. Cost of capital. A heavily indebted company typically has a higher cost of capital, making future projects less attractive. Investors demand higher returns for taking on additional risk. Enterprise value, EV. Debt is factored into EV, a key metric for valuing companies. A high debt load increases EV, but doesn't always correlate with better equity value. Credit ratings. Companies with manageable debt levels often have better credit ratings, reducing borrowing costs. A downgrade in credit ratings due to high debt can negatively impact stock prices. Factors to consider when analyzing debt. 1. Debt trends over time. Review if debt levels are increasing or decreasing relative to revenue and earnings growth. 2. Industry benchmarks. Compare debt metrics with competitors and industry averages to determine whether the company's leverage is typical or excessive. 3. Debt maturity profile. Look at when the company's debts are due. A heavy reliance on short-term debt could indicate refinancing risk. 4. Economic conditions. In rising interest rate environments, companies with variable rate debt may see increased interest expenses. 5. Management's track record. Evaluate whether management has successfully managed debt in the past. Check for transparency in their capital allocation strategy. Debt-related red flags. Declining interest coverage ratios indicates difficulty in meeting interest obligations. Over-reliance on debt for growth. High debt-driven expansion can backfire if revenues don't materialize as expected. Frequent refinancing. A company consistently rolling over debt may be struggling with cash flow. High leverage in a volatile industry. Cyclical or highly volatile sectors are riskier for highly leveraged companies. Interpreting debt in relation to stock performance. Earnings volatility. Companies with high debt are more sensitive to changes in earnings due to fixed interest obligations. Dividends and buybacks. High debt may restrict the company's ability to return capital to shareholders. Market sentiment. Perception of high debt often leads to increased stock price volatility. By examining these aspects, investors can better understand how a company's debt levels influence its stability, growth potential, and stock performance.